Good evening, partners. What a turnaround. 350 partners have joined on a Monday evening. That's really, really awesome. I think the topic is really, really attractive. Together, today we have with us Mr. Manobin. He's a chartered accountant. Sir, you there?
Yes.
Okay. And we have with us Mr. Jinu Jose. He's the regional head for South for UTI Mutual Fund. Hi, sir. Welcome to the show.
Thank you.
Uh, So, sir, thanks. First of all, Jinu, sir, thank you and UTI Mutual Fund for arranging this long awaited webinar. The audience itself shows 350 audience are just at the start of 1 minute. It's like really, really the great thing. We have not encountered this kind of presence in recent in any of the webinars. Okay, Manoban sir, before we start off with the taxation of mutual funds and equities and everything, we have some small questions that a lot of partners get from their clients. Okay, and this is completely a different topic about real estate. Okay, there are two, three queries which a lot of my partners get from their clients. Is first is, sir, what is the taxation if a NRI sells his property in India? And are there any taxations for if NRI buys a property in India? Okay, because I think recently one of my friend, he's an NRI, he sold his property in India and he was told that 20% of the amount has to be deducted here and paid as TDS to the government. Is it true, sir?
Yeah. So if you're talking about the financial year 2024-25, if you sell a property, so basically what will happen is if you are selling a property, irrespective of whether you are an NRI or resident, this government will treat it as a transaction which is happening in India. So if that is the case, in normal scenario, 20% of the total sales consideration will be taxed at as capital gain tax for NRA. Why? Because if it is the case of a resident, it will be calculated based on the actual tax rate. But in the case of an NRA, what will happen is the government is put a condition that the total capital gain should be calculated based on the sale value instead of considering this sale value minus purchase price. So basically, if you're getting 1 crore as a capital, as a sale consideration from the sale of property, the entire sales 1 crore into 20% will be paying as a TDS. And after filing this TDS, what you're supposed to do is, as an NRI, you can file the income tax return, and whatever the excess amount you paid as TDS, you can claim it as a refund. So the 20% is a precautionary mechanism to ensure that the NRI is filing tax return in India to claim the benefit.
So you mean to say, sir, if I bought a property in 90 lakhs, okay, yes, and I sold it 1 crore also, okay, yeah, if I sell the property in 1 crore, I have to, the buyer has to deduct 20 lakhs and pay it as TDS.
Correct.
Even if the entire profit is also 10 lakhs, but 20 lakhs will be deducted and paid as TDS.
Yeah, this part will not be applicable to non-resident. So non-resident always treated at a higher rate to ensure that they will be filing income tax return in India and they are declaring their information properly. It's basically a preventive mechanism to avoid tax evasions.
Okay, so what does this suggest? NRI should not buy property in India? No,
so if they are buying property in India, they have to reinvest. So if their intention is to sell the property and repatriate to outside India, then this condition is applicable. But if he is investing in India, again, the 20% will be deducted at any cost at the time of filing the income tax return. Whether he is taxable or whether the complete sales consideration or the profit from the sales is taxable or not, it will be decided based on how he is going to invest the money. Whether he is investing in the another house property, or he is investing capital gain for bonds, or he is investing in for the construction of house property. So it depends on the intention of your sale. Depends on that. The tax planning can be done, but obviously, if an NRI sell a property, 20% is a blanket rate we have to deduct and remit to the department.
Okay. And sir, if he wants to buy a property, is there any taxation on that?
There is no taxation on buying a property. Basically, you will be paying the registration, the tax the local state tax, but from an income tax point of view, there is no tax on buying a property.
Okay. Got it. Okay. So, and in the rental, sir, what it is?
So in the case of rental, as per the current income tax rule, up to 50,000 rupees, you don't need to deduct any TDS. But in the case of NRI,
Per month.
per month.
Okay.
But in the case of NRI, this is not applicable. So if your NRI is getting any income from rent, then they have to pay 30% plus 4% surcharge. That means 31.2% TDS they have to pay to the government. The same way, after the financial year end, they can file the income tax return and they can claim the excess refund which is remitted to the department.
So you mean to say, how will the NRA pay? The tenant who is paying the rent to the owner has to deduct it and pay a CDS.
Yes, the tenant has to take a TAN number. That is one of the obligation on the tenant. So if I'm dealing with an NRI house owner, I have to take a TAN number. Then I have to remit TDS as an international tax, section 195. Then submit to the government on a quarterly basis.
On a quarterly basis.
On a quarterly basis. It basically is a normal business TDS filing that compliances.
Achha, this comes only when I'm crediting the money into an NRO account, right?
NRO account, yes.
Okay. If I'm crediting the amount in his local account?
Whether if he's having a local account, he may not be treated as a NRI.
Okay.
Because that those complications we'll be discussing today. How a NRI will become a resident in India. So this is one of the complex situations we are facing on a daily basis. We say you are an NRI, bank you say that you are a resident. FEMA say you are a resident, income tax say you are a non-resident. So this conflict is happening everywhere because of there are two laws are applicable for residential status.
Okay. Sir, just wanted to say we have 500 participants, sir. In recent history, this is the biggest turnaround we have till now. Okay, sir, before we start, I want to formally introduce you to everyone. We have with us Mr. CA Manobin. Okay, he sits in Bangalore. He specializes in startups. Okay, NRI transactions, FEMA. Okay, he has a long haul of experience. Sir, would you want to enlighten something about your specialties, sir, before we jump into the presentation?
So basically, I take care of the complete taxation aspects of an entrepreneur. Okay. So it can be basic income tax, or it's a corporate tax, or overseas taxation, or is managing his family funds, or anything related to an entrepreneur who wants to plan their tax, whether in personal capacity or in corporate form, or in the charitable or religious nature format, that is NPO model. So all these aspects we will be covering. I'm not specialized in anything. My specialization is to specialize in entrepreneurs, address their tax requirements, and my major client base is on NRIs because we used to facilitate NRIs to come down to India, settle their business here, and run without having any legal hassle. So I used to work as a virtual CFO for almost 300 plus startups.
300 plus startups.
Yeah, those startups are incubated by ourselves. So this client base is reached over a period of 10 years.
So if anybody wants to start a startup, they can approach you?
Yeah. So we provide the support from the ideation till funding. We provide the complete support system.
With the funding also?
Yes, we provide the funding.
Okay,
not for all, for the eligible startups. There is a evaluation criteria, and if they met the evaluation criteria, definitely they will get the fund.
Okay, done, sir. Okay, sir, I think you finish off with your PPT because I think we have hundreds of questions lined up. Only on this TDS, only at least 10 people are again, please repeat. So guys, don't worry, we'll repeat everything. First, let's, sir, finish off with the presentation, then we'll start one on one.
Yes.
Over to you, sir.
Thank you. I hope the presentation is visible.
Yes, sir.
Okay. Good evening, all. So, my name is Manobin. I would like to take you through the NRI taxation. This presentation is basically focusing only on the NRI and NRI taxation aspects. So, we will be discussing on multiple aspects related to NRI. There will be some jumping from NRI to resident and non-resident or not ordinary resident, but most of my presentation is stick to an NRI taxation point of view. There may be some confusions because the NRI taxation area is very gray area. There are a lot of advisory services which is getting from multiple professionals, from banks, from the chartered accountants, from the finance professionals. So this area is slightly complicated in nature. So 99% can be accurate, and 1% there is a gray area of giving a wrong interpretations. So this, considering this facts, I would like to take you through this session. And what I will do is I will just take you to the complete presentation, and after the presentation we'll have a discussion, and panel members will be asking questions, and I will be giving answer wherever is possible. And if any of these questions I am not able to answer it at right point of time, definitely I'll give you a written response on those questions in a later point of time. So as an NRI, so we will be seeing lot of terms which is used in the documents, in the income tax document, the documents what you are getting from the banks or financial institutions, or when you are trying to remit funds to outside India or bringing funds to inside India. So a lot of terminology we are seeing on a residential from a NRI point of view. So most of the terms we should be familiar. Why? Because we should know what term, where to use, and who is using these terms to understand what is the relevance. Then the second point we would like to discuss is the residential status. As you know that residential status is important to understand what I can do in India, or what kind of compliance system I have to retain with reference to a FEMA point of view, or FEMA compliance point of view, as well as an income tax compliance point of view. There are two types of residential status I would like to brief. One, residential status which is coming from the Income Tax Act. Basically, when after the financial year end, when you try to file an income tax return, the residential status which is coming from the income tax portal or income tax rules, we have to calculate, and we have to decide whether this income is taxable or not. But in the case of a residential status as per FEMA, FEMA is considering as on date. If you, when you are reaching to a bank, you are asking that, okay, I want to transfer certain funds to outside India. Then they will ask, what is your residence status? That residence status is based on the current position. That means as on today, what is your position? Based on that, the residence status calculation. So there will be always a confusing area where what is my residence status, whether it is NRI as per the FEMA or it is NRI as per the income tax. Most of the time, you may not be an NRI in both the cases. So, as per FEMA, you may be an NRI, but if you look at the income tax provisions, you will be treated as a resident but not ordinary resident, or sometimes you can be a resident also, or some of the income may be taxable because you are not an NRI. So those kind of points we'll be discussing. The third one is, the most important thing is income tax return. Why an income tax return is required? Because everything is related to the income tax in India. For financial transaction in India, we have to capture the income tax return. As you know that there is a report called Annual Information Statement. All the PAN holders in India, they are getting a report called AAS, whatever the financial transaction we use or you transacted through the PAN number, which will be reflecting in the AAS report. So irrespective of whether your income, you have to see whether I am really liable to file an income tax return or not. This is one of the gray area where we will be discussing in detail. Then types of income, type of income for the NRIs. Basically, we are focusing only on what kind of incomes an NRI can liable to pay in India. The next, the other point is what we are trying to discuss is taxation of earnings based on residential status. Not all the incomes is taxable in India, but there are earnings, even though if you are an NRI, but you will be liable to pay tax in India, depends on the circumstances. That we'll be discussing in detail. Then the next point we will be discussing is eligible accounts for NRI investment. What are all the types of accounts you can open as an NRI, and how you can translate your money in various accounts. How you can bring money to India, or we can repatriate to outside India. All these things we'll be discussing there. Then tax on mutual fund income for NRIs. So what are the income which is generating from the mutual fund whether it is taxable in India or not. These are all the 7 key areas we will be discussing in today's presentation. The key terms every NRI investor must should know. See, the key terms, basically there are 10 terms which I would like to explain. The first one is resident. So we'll be keep on discussing about whether I am a resident or whether I am a non-resident or whether I am a not ordinary resident. So this residential status, resident or resident but not ordinary resident or non-resident, depends on the law which is underlying to it. If you are dealing with a financial institution, you have to see the residential status as per FEMA. If you are dealing with income tax department or filing an income tax return, we have to look at the residential status as per the Income Tax Act. Then previous year, basically use the term which is previous year mostly is coming in the income tax or tax related documents. The term of previous year is always used in the income tax related document. The similar word which is used by FEMA is called the preceding financial year. In every document or any condition or any documents you read related to FEMA, you can see that preceding financial year, which is a term which is used in the FEMA related to the residential status is concerned. Then the types of accounts like NRI account, NRO account, FCNR account, Gift City Bank account. These are all the accounts where an NRI can invest or they can transact in India. Then the other thing is the KYC, the normal KYC or central KYC or factor compliance. So these are all the another areas where we will be seeing on a regular basis in the documents which we transact with banks and financial institutions or income tax department. Then the another term is repatriation. So when you are taking money from India to outside India, or when you are bringing money from outside into India, so repatriation or remittance will applicable. Those terms, what is the conditions for repatriation and the remittance, that we will be discussing in detail. Then another one is DTAA, Double Taxation Avoidance Agreement, which is one of the major areas where we have to cover. Why? Because there are income which will be taxed in India as an NRI, but we have to use the Double Taxation Avoidance Treaty to get the relief to make sure that you are not taxed in both the countries. Then GAAR, basically a generally anti-avoidance rule, is not applicable to us. But again, I just slightly touching on this. Basically, if you're doing a business, there should not be any income escaping process which is happening or income escaping activities which is happening in India. So GAAR will be addressing on that aspects, but most of the cases it may not be applicable to us, but still I'm just referring this clause. Then TRC, tax residency certificate, again, which is related to a double taxation avoidance agreement. If you are filing any tax return in India or outside India, and if you want to get credit on those tax you paid in the respective country, you have to get a tax residency certificate. So only this through the tax residency certificate, you will get the credit or relief to make sure that whatever the tax you paid in the respective country will be adjusted in the foreign country, or whatever the tax you paid in the foreign country is adjusted in in India. Then basically the forms of what you are filing in outside India, basically if you consider as US and Canada, so form IRS form is 1040 will be filing at outside India, and the same form will be using in India to make sure that you claim the double taxation avoidance and the relief and we use TRC to get this relief. The same model, those who are filing T1 in Canada, when you file income tax return in India, we use those T1 data to understand whether your income is taxable in India as an NRI, and we can calculate or we can review the data which is represented or which is filed in the overseas country to make sure that there is no double taxation is happening because of your presence in multiple countries. That next one we will discuss about the residential status. Why the residential status is required? There is two areas we have to see. One is Income Tax Act 1961. It is talk about the residential status. The income tax is worried about only filing of income tax return and pay the tax in India. So this Income Tax Act residential status is purely based on when you are filing an income tax return, that means after the end of the financial year end, and how you have to decide whether your income is taxable in India or not. In the case of a FEMA, they are not worried about whether you are filing income tax return or not. They are worried about only when you are going to when you are approaching a banker or a financial institutions to remit, or you are a forex dealer to make a transaction, they will test what is your residence status to allow you to take money from India to outside India or bring money from outside India to India. So these two laws will be detailed discussion on residence status. But always remember that when you are dealing with a financial institution, bank, or any institutions, you always refer what is the status, residence status as per the FEMA rule. Never get confused with the income tax residence status rule, because residence status as per the income tax rule has nothing to do with the FEMA compliances. What is the residential status as per Income Tax Act? So basically, if somebody wants to say that you are a resident in India, there are two conditions are attached to it. If you stay more than 182 days in India, that is condition number one. If you stay more than 182 days in India, or stay 60 days in India, stay 60 or more days in India, plus 360 days in 4 years, then if you fulfill any of these conditions, you will be treated as a resident. If you don't fulfill these two conditions, you will be treated as a non-resident. So take the negative versions of the residential status. If you are not a resident, that will be treated as a non-resident. If your stay is less than 182 days in India, or if your stay is less than 60 days in India in a year, and 365 days in last 4 years, then your tax or residential status will be treated as a non-resident. Okay, this is as per the Income Tax Act. When you file an income tax return, remember this always. And there is a template which is available in the income tax portal. You can calculate your residence status for the last 10 years. And you can put all the entry and exit days as per the passport, and you can see what is your actual residence status, which is you don't need to log into the income tax portal. It is available freely available in the outside of income tax portal, and you can just search in Google, calculate residence status EBDT, it will be showing in the Google itself. So just to understand how you are getting taxed, or whether your understanding on the residence status is correct or not, please use that template to make sure that your actual status as per the Income Tax Act and what you are considered for the income tax filing is matching with the actual data. Then the residence status as per FEMA. FEMA is always worried about what is your intention to come to India, what is your purpose, and what is your stay. That means intention to come to India, and purpose of coming to India, or purpose of staying in India, and what is the purpose of your stay. This will be the basic understanding for a FEMA compliances. The rule is only two types of residence status. One, either you are resident or a non-resident. There is no resident but not ordinary resident in as per the FEMA rule. Whether you are resident or whether you are not a resident. This is only two. Whether you are an NRI, whether you are not an NRI. This is the two conditions we will be discussing in the FEMA. If you are resident.
The 182 days is financial year or calendar year, sir?
This will be the preceding financial year.
Preceding financial year.
Yeah. Okay. That means if it is 25-26, but 24-25, if you stayed more than 182 days, then bank will decide whether you are a resident or not. So stay in India more than 182 days in the preceding financial year, that means the previous year, and has come to India for employment, business, or indefinite stay. If you fulfill these two conditions, then only as per FEMA, you will be treated as a resident. Otherwise, you will be treated as a non-resident. You can open a NRE account, NRO account, or FCNR account, or all those accounts are open to you. And the status changes when intention of your stay gets changed. Just imagine that you are coming to India for a shorter visa, but your intentions to stay in India is more for a longer period, but you got only visa for lesser period, even though you will be treated as a resident. Why? Because your intention to stay in India more than 182 days. Okay. So this is the resident status as per FEMA Act. Then let us compare what is the difference between residential status as per Income Tax Act as well as residential status as per FEMA. The basis, Income Tax Act is based on physical presence, but FEMA is always look at the intention plus stay. If you are planning to stay more than 180 days, or if more than 2 years, but you are having a shorter visa, but if your intention to stay in India is decided or considered when we say that your residential status, then threshold limit. So 182 days for the current financial year, or 60 days plus 365 days is the same what we saw in the previous presentation. It will be treated as a resident for the income tax purpose, but in the FEMA, it is always looking at whether in the last financial year, previous financial year, whether you stayed more than 182 days or more. Then status. And what is the purpose? As per Income Tax Act, the purpose is to file income tax return and pay tax. There is no other purpose. But what is as per the FEMA rules? FEMA rules talks about the foreign exchange control. That means remittance to India or remittance outside India. So this is the aspect where FEMA is looking at, and for the income tax is worried about only the tax what you are paying in India. Okay. Then status change. Income Tax Act, the resident status will change only once in a year. But as per FEMA, you can be a resident in the same year as well as you can be non-resident in the same year. Depends on your intention or purpose, the status may get changed. So it is based on an event based, situation based, it can be changed. So every time banker or financial institution take a call, whether you are a resident or whether you are a non-resident. Impact, if you are a resident, your global income will be taxed in India. What is the purpose of FEMA? To understand whether you are eligible to hold assets or accounts in India. So basically FEMA says whether you are eligible to hold assets. There are certain assets which is not allowed for non-residents. So to decide whether you are eligible to hold or not, this FEMA will be looking at your residential status. Then mandate, why? Then we'll come to that ITR filing. Why ITR filing is important for a NRI? Because the residential status is different from FEMA to income tax computation or income tax calculation. Sometimes you may be having a resident but not NRI account or NRO account or foreign currency transaction account. But if as per the Income Tax Act, where status is showing as a resident or resident but not ordinary resident, you may have to file an income tax return. So filing of an income tax return is one of the key point we may have to look into every year. We don't, most of the time people will say that I don't need to file an income tax return because my income is exempt. Your income is exempt only when you disclose or declare this income to the income tax department. But if you take a call saying that my income is exempt, and if you are not following the income tax rule or specifically mentioning that for this income holders no need to file an income tax return, then only will be excluded from the income tax filing of income tax return. Otherwise, everybody, if you are earning any income in India more than 2,50,000 rupees in a year, you are liable to file an income tax return. Just forget about whether you are filing tax or not, but submitting income tax return is mandatory. Why? Because if tomorrow if there is any notice comes, you can argue that I filed my income tax return and I have made best judgment to calculate my tax. So you will not be facing any kind of demand notice or any kind of issues from the department, because department allow your argument only when you file an income tax return. If you don't file an income tax return, it will be treated as a income escaping, or it can be a non-compliance as per the Income Tax Act. So they can take this as a income escaping assessment taxation, and they will be calculating the tax based on that. So whatever they spend in India as well as what you earn in India, both will be treated as an income for calculating income tax, for the calculating income tax. So for an NRI or anybody, if your gross income, gross total income, if you see that if it is more than 2.5 lakhs, better to go and file income tax return. In the case of a senior citizen, up to 3 lakhs is exempt, and in the case of a super senior citizen, up to 5 lakhs is exempt. So if you are coming in this category and if you are sure that without taking any deduction. If your total income is less than 2.5 lakhs, then you are free from filing the income tax return. Otherwise, please file. You are not paying anything to the government, just only a mandatory filing to prove that you did your job. When they come back to you, you can argue and you can give justification to the government. Then who is liable to file income tax return even though your income is less than 2.5 lakhs? This will be applicable to both resident as well as non-resident, depends on, because not on all the situations, but depends on the situations. If you are coming in any of this category, you may have to file an income tax return even though your income tax total income is, gross total income is less than 2.5 lakhs. That is, one is foreign assets or foreign income. If you are having a foreign assets or foreign income, this is basically for a resident, including foreign bank accounts, shares or signing authority in any account outside India, then you are liable to file an income tax return. It's mandatory, irrespective of your income. Then, being a resident and a beneficial owner of signatory in any foreign asset, if you are having any foreign asset or signatory of a foreign asset, then also you are liable to file an income tax return. If you deposit more than 1 crore in a current account during a financial year, then also you are liable to file an income tax return. Government is not worried about whether you are making profit or loss. If you, they are just looking at the threshold limit of 1 CR in a current account, you are liable to file an income tax return. Then if you spend more than 2 lakhs in a year for a foreign travel, again you are liable to file an income tax return. If you incurred more than 1 lakh for electricity bill for a property which you are holding in India, then also you are liable to file an income tax return. Because if you are using 1 lakh electricity in a year, then government is understand that what kind of activities you are doing. This is basic logics.
Sir, you are training all our customers from buying properties, sir.
Okay, TDS or TCS, again, if you are getting TDS or TCS 25,000 or more, then that case also you are liable to file an income tax return. In the case of senior citizen, the TDS up to 50,000. Otherwise, maximum TDS or TCS is 25,000. You are liable to file an income tax return. Then the next one is business turnover. If you are selling product and the total receipt is more than 60 lakhs, you are liable to file an income tax return. If you are a professional, that means providing services, consulting service or some kind of services that we are providing a software related services or advisory services, commission, anything which is more than 10 lakhs in a year, then you are liable to file an income tax return. So filing of income tax return is mandatory. Whether you are falling under the filing of income tax return is also mandatory. Then who needs to file income tax return voluntarily? Government will not force you to file. If you want to get some benefit from the income tax government of India, then you may have to file this return of income. What are all the situations? You can claim a refund. In the case of NRI, we are paying 20% plus surcharge as TDS on the property. But if you file an income tax return, you can claim the excess refund from the government. Then carry forward loss. Last year you made some business and there is no transaction today, so for the current year, but there was some carry forward loss for the previous year. Then filing of a income tax return is mandatory to carry forward the loss, because the loss will carry forward over a period of 8 years. So to carry forward the loss benefit, you have to keep filing the income tax return and make sure that you are compliant as per the income tax law. Then basically establish your residency. If you go anywhere to establish your residency status, or if you want to go for any kind of FEMA related requirements, the basic thing is they will ask where is your submit your last 2 years ITR return. Then maintaining a financial record, especially for loan or going for visa or any related services, you need an income tax return. Basically, you don't need to file an income tax return, but you file, you may get some benefit. That is why the voluntary filing of income tax return comes up. Then the next point is nothing but, so we discussed about residential status. Then we discussed about why to file an income tax return. Then the next situation is whether I am paying double tax or not, whether my income is tax rated twice or not. So for that, most of the countries, India is entered with a double taxation avoidance agreement. It's a treaty, and every treaty is different. So we may have to see which country you are dealing with. whether if you are as an NRI, if you are paying tax in India, and if you want to claim the relief to outside India, you have to get a form which from the income tax department, that is called form 10 FA. So this form will be provided by the income tax department, submit the overseas government to claim the income tax credit. The same time, you are resident in India and your global income is taxed in India, and if you want to claim the double tax, and because when you are a resident in India, whatever the tax you paid outside India, also whatever the income you earned outside India, and whatever the tax you paid outside India, both will be clubbed in India, and you get the relief of the extra tax or additional tax you paid outside India. It will become only through a double taxation avoidance agreement treaty. So basically, the double taxation avoidance agreement talks about salary, interest, dividend, royalties, capital gain. These are all the areas where the government enter into double taxation avoidance agreement. And the end result of double taxation avoidance agreement is basically TRC, tax residency certificate. Wherever the countries you have double taxation avoidance treaty, when you file the tax return in the respective country, you will get a TRC, a document called TRC. This document is important to claim tax relief when you pay tax on the global income. It can be in India or it can be outside India. At any one point of time, you will be paying tax. Either you will be paying tax in India or you will be paying tax in outside India. So global income will be calculated everywhere except the Middle East countries where there is no tax, but near future they will also coming with the taxation. So this global income taxation is nowadays is mandatory. At least one country will be taxing you for your complete income. So India has 90 countries, DTA within 90 countries. So every treaty, when you're dealing with a country or when you are dealing with the country taxation, you always have to read the double taxation avoidance treaty, and you have to see whether you are exempted from filing income tax return, or you don't need to pay tax in India, or you file the income tax return and claim the refund in India. So everything is talks about the treaty. So based on the treaty, the tax professional will take a decision how to handle the extra tax you paid or additional tax you paid for the global income. Tax residency certificate. Basically, as I said, when you pay tax outside India, after filing the respective country's return, you will get a document called TRC. TRC will not come automatically. After filing the return of income, after completing the assessment, if you request to the respective government department, providing that please provide a TRC as per the DTA. So depends on the agreement between both the country, they will issue a TRC, that is for tax residency certificate. So based on the tax residency certificate, you can claim tax relief either in India or in outside India. And when you file an income tax return in India, and if you want to claim a foreign tax credit, then you have to attach a TRC along with your income tax return. There is a report called Form 10F. This 10F will be signed by a chartered accountant, and he will be verifying all the data. Whether he will be reviewing your overseas foreign income tax return also, and based on that, he will recalculate the tax applicability in India, and we can claim the tax credit as per the tax TRC, tax residency certificate. What are the details which is included in TRC? Basically, TRC includes the name of the taxpayer, is mandatory. Then status, whether you are individual or a company. Then nationality, what is your nationality? Then tax ID or PAN number. Then period of residency, tax authority signature and stamp. So these are all 6 details which will be available in the TRC. Then let us discuss about the types of income and types of assessee. So types of let us see the residential status. This is as per the income tax law. If you, as per the income tax law, if you are a resident, whatever you received in India is taxable. Whatever is derived from India, means you work for India, but you are getting payment outside India, that will be taxable in India. Whatever you earn outside India, that is also taxable. That means for a resident, all your income, irrespective of from where you are earning, taxable in India. Resident, not ordinary resident, what is the status? Received in India, definitely it is taxable, because Indian law is whatever you receive in India is taxable, subject to certain conditions. some of them will be exempted, some of them will get a relief. Okay, but in the case of resident but not ordinary resident, if the income is derived in India, that means you are working, you are you are sitting outside India, but the payment is coming from a employer from India, that will be treated as a derived from India. Then such kind of income will be treated as Indian income, because even though if you are receiving outside India, the remitter and receiver both are having an Indian connection. So you will be taxable in India in the case of a resident but not ordinary resident. Global income for resident but not ordinary resident is exempt, because global income is not considered in tax, because you will be filing an income tax rate in the respective country. Non-resident Indian, whatever the income you received in India is taxable, no doubt. Is derived in income derived in India is exempt, and global income is also exempt. So these are the three categories, three types of income you have to always remember. Taxation of earnings based on residency status. So let us talk about resident, not ordinary resident, or non-resident. Global income for non-resident, only Indian income is taxable. But in the case of resident but not ordinary resident, only Indian income taxable in only Indian income, like NRI, whatever the income you are receiving in India, it is taxable both for NRI as well as resident but not ordinary resident. Foreign income taxability, whether foreign income taxable for NRI in India, for NRI in India, foreign income is exempt. The same way, the foreign income is exempt for resident, not ordinary resident also. Indian income tax. Indian income tax liability taxability for all the incomes, it is fully taxable in India. For NRI, for resident but not ordinary resident also fully taxable, because whatever you are getting in India is fully taxable. Foreign asset reporting for non-resident asset is required. If you are having a source, if you are having the source in source, then you may have to file the foreign assets. But for a resident but not ordinary resident, foreign asset reporting is not required. Why? Because you are not paying any tax on those assets, the revenue generated from those assets. Double taxation avoidance agreement, it is applicable for non-resident as well as resident but not ordinary resident. Foreign capital gain, not taxable for both the cases. And retirement pension funds abroad, not taxable for NRI as well as not taxable for resident, not ordinary resident. Dividend income from foreign companies, same like it is not from India, so it's not taxable for both the case. NRI is also not taxable, and not ordinary resident also not taxable. Eligibility for resident tax benefit. No, NRI is not eligible for any deduction like ATC or ATD or any Chapter 6 deductions. Why? Because your income in India is not taxable in India, so you are not eligible for claiming any deduction from India also. But the resident, not ordinary resident, eligible to claim ATC. Why? Because a certain portion of his income which is taxed in India, even though if it is not received in India but is derived in India, it is getting taxed in India. So government is providing the benefit of claiming ATC, ATD, and Chapter 6 deductions. What is income derived in India? So this is one of the interesting areas to understand. Whether if you receive any income, any amount outside India, it will not treat as a foreign income, or if you receive an income which is in India, it will not treat as an Indian income. So we have to see where it is derived. Salary for work done in India. If somebody is working in India, and if you are receiving salary in India, it is taxed as Indian income. So taxable for both the resident and resident, not ordinary resident. Salary paid in Singapore for work done in Singapore. That means your salary is received from Singapore, a foreign country, and the work done for a foreign country. Both the case, the tax is exempt. Why? Because the amount is derived outside India. Interest from Indian FD or NRO accounts. Indian FD, NRO accounts, the income is generating from India, so you are liable to pay tax in India. There is no doubt about that. Interest from foreign bank account. That means if you have foreign bank account and if you are getting interest, this is not generating in India, so you are not liable to pay tax. Rental income in India, definitely it is an income generated from India. You are liable to pay tax for both the case. Capital gain from Indian shares or mutual funds. If you are because Indian shares and mutual funds derived in India, but there are certain countries, they will provide double taxation avoidance treaty, through that the income tax is exempt from mutual funds, depends on the double taxation treaty. So you have to see what are all the countries where double taxation avoidance treaty is applicable? Basically, UAE, Singapore, Kenya, Malaysia, and Mauritius. If any of these countries, if you are from any of these countries and you are having a mutual fund income, as per the double taxation avoidance treaty, you can claim as nil tax, but the condition is you have to file income tax return and you get the tax residency certificate. So just blindly saying that I'm staying in outside India, UAE or Singapore, and my income is not taxable, that is not the correct understanding. To get this mutual fund benefit is exemption as per the double taxation treaty. First, you have to file the income tax return. Then only you will be coming under the purview of the double taxation avoidance treaty. Then you can say that this income is exempt. So the declaration is mandatory when you file an income tax return. Foreign pension, it is not taxable in India. Foreign business income, but paid by Indian client. You are getting a foreign business income, but it is paid by an Indian client. Definitely that is treated as an Indian income. So you are liable to pay tax in India for an NRI. Then let us talk about types of accounts. The first type of account is NRI account. So basically the NRI account is basically an external account where the purpose of opening an NRI account to bring or park your foreign income in India. So basically whatever the income you are earning from outside India, if you want to park in India in INR, so NRI account will be help you to park those amounts. So this amount is fully repatriatable. Why? Because this is coming from outside India, and when anytime we can take it back. There is no restrictions attached to it because it's the income what you earn from outside India, and there is no connection from Indian transaction. So the full amount what you are parking in NRI account, you can take it back anytime without any conditions. Interest earned from NRI account is fully exempt. Always remember that NRI is basically an external account. It is for the income which you are generating from outside India. So there is no tax on the NRI transactions or NRI account transactions. NRO account, you are a non-resident Indian, but you are getting income from India or you are getting receipt in India. The only one account we can use to receive those money is called NRO. Non-resident ordinary. Ordinary is basically nothing but within the country or local. So you always remember that NRO is basically a local account to receive money from India. So normally the basic income what you are receiving in NRO account is basically rental income, dividend, pension. All this money is coming from INR to NRO account. Repatriation limit is allowed up to 1 million USD is allowed per year. So if you want to take money from NRO account to outside India, that means transfer NRO account to NRI account, then we can transfer up to 1 million USD per year. From next year onwards, that from 2025 onwards, you can transfer 2 million USD per year. NRO account income always is sitting in India and it is related to the income generated from India, so always be taxable. FCNR account. So this account is allowed to NRI to hold foreign currency accounts in India. So like a USD account, GBP account, Euro account, basically it's a tax. So if somebody wants to park money other than INR, they can use FCNR account. Basically this money from outside India, you can park in foreign currency account. So this is completely tax-free account. Any income which is generating from the FCNR account is fully exempt. Then another one is the latest trending subject is gift city account. To the Gujarat International Finance Tech City, there are a lot of products which is coming up. There are a lot of mutual funds investors are coming in. So any transactions or any fund transaction which is happening from a gift city, it will be treated as a transaction which is happening in outside India. So it is treated as completely exempted, subject to certain conditions. So this we have to see who is your IFSC or what kind of products you are dealing with. But from any transaction which is incurring from a gift city account is completely tax-free, subject to certain conditions. There is no blanket rule saying that all the gift city accounts are tax-free or taxable. Depends on the situations. We may have to see whether gift city account is taxable or not. But in a general terms, all the gift city accounts are tax-free. Mutual fund set up in a unit in gift city. If you are a mutual fund set up in a gift city, and if you're investing there, no tax on management fee for 10 years. There is a tax benefit, and there is no capital gain. There is no security transaction tax. There is no securities. There is no stamp duty is required, and this money is freely repatriable in as per the income tax FEMA rules. So that means whatever the money you are depositing gift city, because this money is coming from outside India, so we can anytime you can take it back. So there is no permission is required from the FEMA. Then let us discuss about the capital gain. How to understand what is my obligations to the government when I'm having a transaction in India. If you are an NRI, long-term capital gain, if it is an equity-oriented funds, up to 1,25,000 is exempted. If anything is more than that, you may have to pay 12.5%. There is no indexation available for equity-oriented funds. So holding period is more than 12 months. If any fund or any instrument which is held more than 12 years, it will be treated as a long-term capital gain. For the equity-oriented funds, you will be liable to pay 12.5% tax, and the exemption limit is 1,25,000. Short-term capital gain on equity-oriented funds. If it is less than 12 months, it will be treated as a short-term capital gain. The short-term capital gain is 15%. This 15% is exclusive of surcharge and cess. So whatever the surcharge and cess is applicable, you have to pay. And always there is no indexation benefit is allowed for this. NRI capital gain on non-equity funds. What is status of non-equity funds if I have any gain? Short-term capital gain. If it is less than 36 months, it will be treated as a short-term capital gain. The normal tax rate which is applicable to NRI depends on the slab rate, which slab you are coming as a taxpayer, that on that rate you will be paying. If it is a long-term capital gain more than 36 months, then you will be paying 20% with indexation. This is what I'm talking about, the tax rate which is applicable for the financial year 2024-25. We are not talking about the finance budget 25-26. Okay, there are a lot of changes which has happened. If I compare both, it may not be. I'm not sure whether we will be able to afford the both tax complications. So I'm focusing only on the current financial year, that is 2024-25, and please focus on this whatever we are discussing about, which is applicable only for the tax filing of 24-25. That means which is undergoing now. Dividend and dividend income and TDS. So taxation is a slab rate on the investor's hand for 2024-25 as well as 2025-26. Same is taxable. Resident, if you are a resident, then dividend and interest income, dividend income is not applicable. And if you are non-resident, then we may have to deduct 20% as a TDS. If it is a short time, it's a 20% TDS. If it's a long time, 12.5% TDS we have to deduct. The same applies for the next year as well. Then the last one, we will discuss about the KYC. Why KYC is required? Because the KYC talks about a lot of documentation part. So we have to see what kind of KYC you are seeing on a regular basis with the financial institutions. So basic KYC is basically the normal KYC is like when you going to a bank to open an account, NRI account, NRO account, or any account, they'll be asking the basic document like PAN, passport, and utility bills. These are all depends on the KYC is based on the bank or financial institution basis. Whenever you open a bank account, you have to submit your KYC. There is no doubt about that. There is something called central KYC. The central KYC is this one managed by PRESI. So it's a 14-digit digital ID. This is basically used for investing in mutual funds or any securities instrument. You have to submit a central KYC. Otherwise, for the normal financial transaction, you need to submit only a basic KYC. Yeah. So I hope that I have concluded within 1 hour. So let us open the question.
Manobin sir, thank you very much. I think a lot of people have a lot of questions. Okay. Sir, first I will talk about Preeti Balani is asking, I want to know the taxation rules for NRI who has gone to Ireland.
Taxation rule for so it
NRI.
depends on the residential status. That is the one thing you have to see. You always check the residence status. What is your residence status? Whether you are liable, even though if you are going outside India, you are liable to pay tax in India, depends on your residence status. The second thing what you have to refer is DTA. What is the double taxation avoidance agreement? We can utilize it, and when you become a resident or taxpayer in Ireland, if you are liable to pay tax, then the Indian government or Indian income tax department will provide you a TRC, that is tax residency certificate, so you can claim your tax benefit. As of now, there is no single answer for this. Depends on your period of stay in India and period of stay in outside India, and the income what you are generating in India, income what you are generating outside India. Based on that, you have to take a call.
So now Yogesh is asking if any customer stays in USA and is investing in SIP in India, okay, then what is the tax for withdrawal if he comes back when withdrawing to India, and what will be the tax if he stays in USA only and withdraws it? Will there be any difference?
See, if you are, that is depends on your residence status again. If you are staying outside India, you will be treated as a non-resident, but the SIP investment is happened in India. So when you sell a SIP, it will treat it as an Indian income. So you are liable to pay tax in India, but you will get a relief on this tax by using the double taxation avoidance agreement. That means basically you have to file an income tax return in India, take the TRC and file the respective country along with the tax return.
So residential status basically defines is which country you are staying in, and 182 days, whatever you have told at the start of that thing.
Yes.
Okay. Sonali madam is asking, I'd like to ask about the taxation rules of an NRI who has gone to Muscat, Oman for employment. The person is not a citizen of Oman but holds an Aadhaar card, PAN card, and has completed proper NRI KYC. If this person sells Indian stocks or mutual fund before returning to India permanently, that is before retirement, will they be liable to pay capital gain tax in India? How will the taxation work in such a case?
Definitely, you are liable to pay capital gain tax in India because the securities are sitting inside India, and whatever the income or capital gain we are generating, you are liable to pay tax. But if it is a mutual fund, there is a clause in the double taxation avoidance agreement that in the treaty. You have to see, and based on that, we can declare this as whether it is exempted income or taxable income. So when you are filing the tax return, we have to see the respective countries' double taxation treaty, and you can decide whether you are liable to pay tax and get the TRC, or you don't need to pay tax in India.
Where do we get all this list, sir?
Tax residency certificate.
Yeah.
Tax residence certificate will be available in the income tax portal. There is a separate form which is available. You have to request for that. Double taxation avoidance agreement, you search in Google, all the double taxation avoidance agreements are available, or it is available in the income tax portal also.
Okay. So in UK and US, what is the additional tax you have to pay if long-term capital gain tax is paid at fund level by AIF or CAT3? Arjun Sarkar is asking.
That means this is taxation outside India is a UK.
UK and US.
That depends on the global income. We may have to pay tax. That is depends on that. I may not be able to give a simple answer for that. But the condition is, since you are outside India, so whatever the global income you are generating, you will be liable to pay tax outside India. So you have to see the relevant provisions which is suitable or applicable to you, depends on your residence status and country of residence and the tax identification number. Based on that, we can decide. But if you ask for a direct answer, it is very difficult to see because we have to do a diagnostic test to understand what is the stage of your income and the taxability.
Okay. Kaushal Kotar is asking, one of my clients wants to invest 1 crore and opt for a 70,000 rupees SWP. Okay, so what will be the taxation if these guys staying in US?
So investing in 1 CR and what is the second part?
70,000 is withdrawing every month as SWP.
So withdrawing through which account?
He has not mentioned.
This money is a fund. It depends on which account you are depositing. See, when you transfer money from outside India to India, there is no tax.
Okay.
So it is.
NRO account.
So whatever the money you are depositing in the bank of NRO account is basically a tax free in India because you already pay tax. So that money you can freely use in India. There is no restrictions on that. And when you take a repatriation to India, bank will ask certain questions. Those questions is decided based on the FEMA compliances and your residency status. And the purpose of withdrawing this money for the Indian to meet the expense in India, there is no restrictions as such. But if you are trying to invest in any financial instruments or stocks or mutual funds, you have to take the approval of the AD banker. So they will decide whether you are able to withdraw this money for that particular purpose or not.
So basically, SW means automatically every month that redemption happens of 70,000 from their account, and it gets transferred to the account which they have mentioned.
Yeah. So if money which is coming from outside India and if you transfer it to any account,
they've invested 1 crore in a mutual fund in India.
Okay.
They have opted for a monthly redemption of 70,000 to a systematic withdrawal plan. So every month that 70,000 is going and getting deposited into the NRI account.
Okay. So there is no restrictions of transferring from.
So what is the taxation?
So that is depends on what is the redemption amount.
70,000 per month.
70,000. What is the amount which is invested? What is equivalent amount of 1 CR? You have to see how many units you are selling. You have to find out the capital gain, whether it is short time or long time. That the difference will be calculated as tax in India.
Okay, it will be taxable in India.
It is taxable in India.
Okay.
Because basically they are doing a redemption of investments.
Okay. Simran Zubetar is asking, can NRIs take mutual fund redemptions in NRE account? Back of NRE account?
Mutual fund redemption NRE account is not possible. So whatever the income, what you are generating from India, you first is to go to the NRO account. From there, repatriation rules applies. From NRO account to NRI account, you can transfer. But direct transaction from NRI account is not allowed.
Mr. Brahmarao sir is asking, NRO account, can money be taken without certificate from CA and RBI approval like NRE account?
Up to $1 million US you can take. So for the 2025 onwards, it's $2 million US.
2025, okay. Leela Madam is asking, can we submit TRC while investing or should we submit to IT department while filing ITR?
It's always while filing the income tax return.
Okay. As per FEMA, Nisha is asking, as per FEMA, you become NRA only after 182 days and not from day one. Am I right?
Yes.
Okay. Vijayendra is asking, NRA MF tax applicability accrued or on redemption?
All taxability will come only on when you get an income. So the transaction point is nothing but when you say or when you redeem, you will get an extra amount. So investor amount plus profit is called redemption. So that profit will be taxed in India.
Okay. And for non-resident, what is the derived income?
Non-resident derived income is if you are getting an income from India from an employer, but you are sitting outside India, the services you are given in India and the amount is paid from India, but you are receiving outside India, that will be as a redundant. That means you are just simply sitting outside India, but everything is happening in India.
Okay. Sachin is asking, why is it asked that NRE or NRO account for mutual fund account depends on what you would be doing with the money afterwards? Why is it asked?
See, nobody will ask any question after paying tax. Okay. So basically the intention is you transfer this money to a respective account, pay the tax, take the money out, and follow the RBI rules or follow the AD banker conditions. If sometimes they ask for 15 CSEB or up to 1 million USD free to withdraw. So there is no concern on that.
Okay. Mr. Haribab is asking, long-term capital gain for NRIs is 12.5%. Whereas if they invest through Gift City, there is no tax to be paid in India. Is he correct?
Correct.
Okay. So everybody says, sir, setting करके Gift City का amount थोड़ा नीचे लेके.
So the Gift City, how you are parking this money in the Gift City account, that is a concern. From the resident account to Gift City account, transfer is not allowed.
Yeah.
The gift city account is coming from to park money which is coming from outside India.
Yeah.
So basically the money should come from outside India. That means already taxed in outside India. So that amount is tax free. When you invest and if you earn something extra also, that is happening in outside, and the gift city is a place which is outside India. So you have to understand that gift city transaction is happening outside India. So whatever the earnings which is generating from gift city is treated as exempted. Why? Because this is not part of India.
Okay. In NRE and NRO accounts, taxation is same, right?
NRE account tax free, NRO accounts taxable.
Okay. US NRIs can invest in mutual funds. I think a lot of mutual funds allow that, and some mutual funds don't allow that.
That is depends on the fund.
Funds, yeah.
So there is no restrictions as of now, but this kind of questions, there is something called FATCA compliances. Whether a US citizen is investing in India, so you have to file the FATCA compliance KYC, and if it is allowed, definitely the mutual funds allowed.
Otherwise, हम लोग इन्वेस्टमेंट लेते हैं क्या एनआरए का यूटीए में यूएस का? I think UTI takes it. Okay. In NRI cells, I think. Okay, in USA and Canada, there is no double taxation, right?
Sorry?
In USA and Canada, there is no double taxation.
Every country we have a double taxation treaty. But if it is Canada or USA, you have to pay tax and get a TRC from India to get the tax benefit outside India.
Okay. Mr. Haribabu is asking for NRIs and RIs, the basic exemption limit is 2.5 lakhs to file a tax in India. Assume the NRI's FD interest from his NRE account has crossed more than 2.5 lakhs. Should he file a tax and any tax to be paid as it crosses 2.5 lakhs?
2.5 lakhs, definitely he has to file an income tax return. And because this total income is more than 2.5 lakhs, definitely they have deducted the TDS of this. So whatever the money which is lying as TDS will be get refund if you file income tax return. Other than that, there is no tax liability till your income crosses 7.5 lakhs for the previous financial year, that is 2024-25.
NRI is having a property in India, earning rental income from India, depositing rent in savings account. Does tenant have to deduct TDS? What if the owner does not have any time?
Basically, this is a FEMA violations. You will get up to 2 lakhs rupees, and every day you will get 5,000 rupees. It depends on the. Basically, once you become an NRI, you are liable to convert your saving bank account to a this one NRO account. So conversion of SB account to NRO account is always permissible.
Okay.
So getting when you are holding a status of NRI and retaining a saving bank account and getting a rental income in that account, from the remitter point of view, from your tenant point of view, you don't need to do. Why? Because he is paying inside India and he don't know whether you are NRI or a resident. So he is assumed that you are a resident, but you know that you are a non-resident, so you should not hold any saving bank account in India.
So if money is invested to NRI account, can the withdrawal be taken back to NRI account?
Yes. No restrictions.
Sir, any idea of what is Flamingo tax of US and how will it affect India investment?
that I may not be able to give an answer to this now. Okay. Because that is a totally different subject. We may have to. I have to give an overview, and we have to bring that person to a level of understanding. Then only I'll be give an opinion on.
Sir, Leela is asking, irrespective of withdrawal, for all the USA NRA have to pay taxes on accrual as well. Is it true? No.
Accrual basis.
Yeah.
So if income is accrual is happening when, like an income which is
investing in
reinvesting in reinvesting in, and if you are in
they have not
accrual, basically what the accrual concept is that you are getting an income. So in the case of FD, you will get interest income every year, but it will not come to you.
Okay.
So it is, even though if it is not coming to your bank account, it will treat it as an income, which is under the accrual concept model.
Okay.
So for that, you are liable to pay tax in India. Because your 26 AS or AAS report will show that this much interest is remitted to this person, even though if the bank account is empty.
Okay. Sir, can we do investment in mutual funds from Gift City account and will it be tax free?
If it is investment, Gift City account is tax free. We have to find a mutual fund which is functioning from Gift City.
Okay. And this 2.5 lakh limit will be changed to 4 lakhs from next year, right? Next financial year.
Yeah.
And while redeeming mutual funds, they are giving options to take money in another account. How is that possible if it is not allowed?
If you
Similar
invested through NRI account, then money can be taken back to NRI account. But you invested from a resident account, and if you're saying that transfer this money to NRO account, that is not possible. Why? Because during the redemption time, all the fund houses will ask, show me the source from where you invested, whether it's from resident account or NRI account. If it is an NRI account, definitely they will transfer this money back to the same account.
Okay. Taxation of NRE income, NRI need to file investment for years. Okay, sir. Everybody is asking, can we get the PDF? Can we get the PDF? Can we get the PDF?
It will be available. It will be available.
Okay. NRI is having property in India and rental. What is the duty of tenant who is paying rent in his savings account? Again, this tenant is asked to take TAN. So, sir, can you just repeat this one? Because approximately 15-20 people have got confused that how the TAN number should be taken, why should it be taken by the tenant?
If you are a NRI and if you have a tenant in India, the first condition is the money should remitted to your NRO account because you are not a resident to hold a saving bank account.
Okay.
When somebody is transferring money to an NRO account, then this will be tracked as overseas transaction or foreign transaction. So that person is liable to deduct TDS on that. So basically, he has to get a TAN number, and every month he will be paying tax on or before 7th of the next month. And at the end of the third month, at every end of the quarter, he will be filing the TDS return, and basically you will get a Form 16 on every quarter, like how you get a Form 16 from the bank or from the other financial institutions for the investment. The same way you will get it. So the obligations on filing of tax or directing TDS is on the tenant. Why? Because he is paying to NRO account. But if you are saying that you are even though if you're an NRI, but my resident status is I have a saving bank account, you would remit to my saving bank account, then you don't need to take any extra precautions. You can keep transferring to a resident account, but some more other day, you will be coming under the scanner of either in FEMA or with income tax. Both will be having severe penalties.
And one question: who will be getting that notice of 2 lakhs and 5,000 rupees per day? The tenant or the owner?
Owner.
Owner. Okay. So Deepak is asking: a person is air hostess and working in Singapore and comes in to India in every 2 to 3 months. In case he transfers his salary in Indian account, does tax apply on him?
No, because that amount is already taxed outside India, and you are transferring only the tax-free income. After tax, post-tax income only you are transferring. It's not taxable.
Okay, sir. At least more 100 questions I have. Senior citizen earned 10 lakhs from stock market. Still his income is less than 12 lakhs. Is there? And there is no other income. Is he required to pay short-term capital gain?
12 lakhs for the next financial year, that means 2025-26. The 12 lakh exemption is allowed only for the salary income, not for other income.
Okay.
So basically, you are liable. Yes. Yeah, that is only for salaried class. That the law is made only to address these middle class people.
Oh, only for me it is 12 lakhs, not for all the Okay. Sir, my client has been staying outside India since 4 years. But before this, they were working in India, earn salary in India. They have PF accumulated from Indian company. Should they withdraw it in savings or NR account where it is taxable? And if it's possible to take it into NRE account, PF money.
When you are outside India, there is nothing a concept called saving bank account. Your saving bank account automatically or liable to convert an NRO account.
Okay.
And whatever the receipt from the PF account, that depends on the maturity, depends on the period of holding, it will be taxable. If it is less than 5 years, it is taxable. If it is more than 5 years, I think it's tax exempted. So we have to see what is the status of his income.
Nisham is asking the tenant is not ready to do the procedure of TDS. What should I do?
Give it to another person.
Find a new tenant.
Because we can avoid interest and penalty or non-compliances.
What is
it? It is not a choice because it's a obligation to the tenant for holding an NRI property.
Amounts are required for the rent?
Sorry?
Rent amount, what is the amount?
There is no amount limit for NRI.
No, the rent the limit.
There is no rent limit for NRI transactions.
But 10,000 also.
Even you transfer 1 rupees also, you have to pay. You have to pay.
Oh, Nisha madam, you have to sell the house now immediately.
But if in the case of a resident, then we have that if it is for residential purpose, if it is more than 50,000 per month, then use 2% TDS. And if it is a commercial transaction, less than 50,000, no TDS.
Okay. In case investor fund, so I think a lot of people are answering the questions. That's very great. Lot of
peer learning.
Yeah, answering the other questions. I think they also understood that there is too much load. People are not trying to answer. Okay, I think we are almost done with the questions, sir.
Thank you.
Okay. Thank you, Manobin sir. Still 400 partners are live. It was a mind-blowing session. I think lot of doubts have got clarified today.
Okay.
And, I would really thank UTI Mutual Fund, Jinu sir, for providing us this opportunity. Jinu sir, by any chance, Siddharth sir has joined?
Sorry, I didn't get you.
No, I just asked. Jinu sir said that Siddharth sir might join. That's why.
Okay.
Okay, sir. Thank you very much.
Thank you so much.
Okay.
Yeah. Bye-bye.
To have this session once more, because still a lot of people are only half satisfied with the answers. They want more answers. So maybe soon we'll come down again for one more meeting, sir.
Yeah, I always recommend a physical meeting because I will be able to interact more with them. So it will be able to convince them properly, because there is a limitation of online meeting where I may not be able to take everybody into the same platform. So I have to take people to the same platform when everybody is sitting together. So there are a lot of synergy effect which is happening when you have
in Bangalore. You are ready to travel, sir, for us?
If you have a sessions, definitely I can travel.
Okay. Jinu sir, we have now got a big person in demand. Now everybody wants him.
Sure. No problem.
Thank you. Really thank you for sir organizing this session. Thank you, sir. Thank you, Manu.
Yeah, thank you so much. Yeah. Bye-bye.
Thank you so much.
Bye.
Bye.